Hello, welcome. It is June 12th, 2026. We're in Talktoptera number 6, discussing recursive self-improvement is a portfolio optimization problem, here with York of the authors list. And we'll just jump right in. So, York, thank you for joining and looking forward to this presentation and discussion.
Yeah, thanks, man. Thanks for having me. So I think sort of the right place to start is, I think to kind of, first of all, it's like, what is portfolio optimization? Then also, what is recursive self-improvement? Those two things, and then how do you sort of recast recursive self-improvement as a portfolio optimization problem is kind of the idea of the paper that we gave. And then, of course, we walk through it and give a little bit of evidence for it. But the first thing, when we're talking about portfolio optimization, we can kind of start off there. Portfolio optimization is really the same thing, actually, as reinforcement learning, is the same thing as model predictive control, stochastic optimal control. And under the right units of analysis, even something like variational inference and even things invented back with Lagrange, the calculus of variations. They're all optimization problems of a sort, usually prediction optimization problems. But portfolio optimization was first kind of invented in like the 50s by Markowitz. And what they did was they said, we're trying to rebalance a portfolio each day, and we're going to make a prediction of what the portfolio is going to be tomorrow. And we're going to do that by taking the rolling average. So they take like the mean of the returns on a day-to-day basis, and then have a vector for that. And then they have a covariance matrix relationship between all of those returns. So Apple goes up by this amount, Tesla will go down by this amount or whatever. And then they use that as a model of what they expected the economy or what they expected the prices to do. And they'd make a projection for one step in the future. And then they would do this, linear program, this optimization, this convex optimization solver to pick the, weights of the portfolio that would get them the best risk-adjusted return. And, or that, they could do the best just absolute return, or you can put a bunch of different risk functionals on it. And that was really the start of portfolio optimization. But if you don't really appreciate where it comes from, it's not immediately obvious how they came up with these formulas. But if you go back even farther, you see that there's this probability theory line of thought that comes out of people like Kolmogorov back in the 20s. And from that you sort of get on the opposite side, you have these calculus people, stochastic calculus, people who are trying to model particles in physics, for example, in the 50s. They were trying to like Monte Carlos, for example, a lot of this stuff. And what the kind of intuition was after they'd come up with a formula for this Brownian motion of particles, they were trying to, figure out how could we design systems that allow us to control these particles in order to achieve an objective. And so whenever you're describing these particles, there's a drift coefficient, and then there's this like volatility coefficient. There's this variance movement around, right? And it turns out that that's the direct analog of the drift coefficient, where the particles are just kind of moving in a direction. That's the returns of an asset price. And the variance is, the sort of noise term for the Brownian part of it. That's the volatility of the asset. And so as a direct, they basically took exactly what we were seeing in this, Hamilton-Jacobi-Bellman equations is what they call them, but these stochastic particles and the physics side of things, and they took it and they put it into portfolio optimization problems. And so that's really kind of like the beginning of portfolio optimization. And since then, alongside one another, portfolio optimization has gone from, I want to optimize my portfolio over just one step in the future. Instead, you might say, well, I want to optimize my portfolio over the next trade and the next trade and the next trade, or maybe 50 trades or 100 trades, or maybe arbitrarily far in the future. So you have multi-step portfolio optimization. And at the same time, you have the exact same stuff happening in, there was a Shell linear matrix solver that came out in 1961 or something that Shell Oil used to optimize the valve controllers on their petroleum refineries. And you have all these different, you have the SpaceX rocket as another example where it's landing. In fact, if you look at the Apollo lunar missions, they were using model predictive control. So they had a rocket equation that tells them how the thrusters work. And they would use that model, they would make predictions, and then they would do optimizations over them. So there's just this long history of people essentially having a model that predicts the future and then doing optimizations over those predictions in order to achieve an objective. And over the years, the technology has gotten more and more sophisticated. So portfolio optimization at this point is reinforcement learning. Like there, all of the papers that you'll read, all of the state-of-the-art stuff is, instead of your model being mean and variance of prices, it's deep neural networks taking in all of the price information and making these very, sometimes even probabilistic predictions of prices. And you have, multi-step predictions with complicated objective functions, maybe multi-objective optimization. And so you're starting to get into the period where the differences between something like AlphaGo, which is sort of the big daddy, right, of or Mu Zero, which is an even better version that came out later, Alpha Star. These really cool model-free reinforcement learning algorithms directly are used in the finance industry to try and model and allocate resources over a portfolio. And so that's really like the portfolio optimization problem. It's pretty much synonymous with reinforcement learning these days. And it's synonymous with model predictive control, which is what people like Jan LeCun or Fei-Fei Li would use to describe where a world model fits into this, right? So that's kind of the background of that is when we say portfolio optimization, it's kind of the finance term for what everyone else is sort of doing. That's the fact that those two are the same is really the interesting thing there. The recursive self-improvement stuff, that goes back to, you have Schmidt-Huber's Gödel machines and these kinds of things, but even like I.J. Good talking about intelligence explosions, right? The idea that an algorithm can make a newer version of itself and makes a newer version of itself. And you get these very quickly, these sort of exponential curves of self-improvement. And we see this kind of behavior all over the place as well, like bacterial colonies. You'll see exponential growth there as well, where they'll grow and grow and grow. They tend to S-curve, obviously, as resources run out, which is actually kind of the reason why I think it's one of the interesting things that is often not considered in recursive self-improvement literature. But all over the place, you have these intelligence explosions, these exponential curves in nature and in a variety of different scientific fields. And recursive self-improvement is usually considered as like a software problem, right? You're saying a software rewrites itself that gets better, that rewrites itself that gets better. But I don't think that that like way of thinking about it endogenizes all of the relevant variables for the process of recursive self-improvement. One example is the enormous amount of capex required to buy the chips upon which that improvement is occurring. That's obviously part of the problem, right? You need to endogenize that into the recursive self-improvement process. Um, Acquiring the data. If you have Scale AI hiring a bunch of people to go and, McKinsey consultants writing out deep research reports as, to help you, um, train your neural network, that's also something you'd have to endogenize. So the curation of the data. And then also, of course, the people using your product, the data that you collect from users. If you don't, that's another place where you start to touch the outside world. And so the recursive self-improvement process really contains, when you really think about it, the appropriate level, I think, of analysis is more the company that is producing it. So like Anthropic as a company and its business relationships is really a better unit of analysis for the recursive self-improvement process because it includes many of the constraints and the costs, the liabilities and the assets that are required to understand how that process will actually unfold most likely in the real world if it turns out to be a language model company. Well, that's kind of the first point here is that we say like every flop, every bit of data costs money. And the domain where that kind of tends to matter is basically that self-improvement is an economic problem. You have to understand the relationships. And then, of course, on top of that, there's economy enters in another interesting way where if these companies get very strong, you have the people like the Eliezer Yudkowskis, the if anyone builds it, everyone dies kind of thing. That's another way where the game theory of being an extremely powerful AI also enters the picture. So there's a lot of ways in which I think that it's best to understand the system that is producing the self-improvement at a more broad level, at really the corporate level and the corporate level plus legal plus these other things. So the first part of the thing is we kind of in our paper we kind of walk through the mathematics, the sort of scaffolding of how you think about this. A company has shareholder equity, and there was a Supreme Court case, Dodge v. Ford, where the Dodge brothers sued Henry Ford for being too kind to his workers, essentially paying them too much money. And that was when it was like legally mandated, essentially, by the Supreme Court that a corporation has to maximize shareholder value, has to maximize shareholder equity, which means assets minus liabilities, right? And then, you can start to say, well, if we're going to cast a corporation as like reinforcement learning problem or a portfolio optimization problem, there needs to be some sort of reward. So that would be, the change in the company's equity from one period to the next period to the next period to the next period. And this roughly corresponds to, getting a little bit better returns on a move and go or something. And then you take the discounted sum of that future changes in equity. You take some sort of measure over it. Usually it's the average or something. But you have this set of possible futures that could occur based on the decisions you're making. And you're going to be, that's essentially what your objective function is, right? Is having the maximum discounted sum of future changes in corporate equity over time. And so already we have some of the machinery here. And you can also think of a corporation as a bundle of assets. So, and this is where really like the true to form, reinforcement learning or model predictive control starts to enter the picture, right? You have your sensors. So the sensors would be, broadly speaking, like the data, right? So if you're the Apollo mission, that's the Kalman filter that's taking in the data. That's the screen pixels if you're training on an Atari video game, or the DNA if you're training a protein folding model. And so the same thing is true of arbitrary corporations for reasons we'll describe a little bit later. The corporation we're going to focus on in this paper is a quant fund, because it turns out that I think it's the most well specifiable, right? So the sensors in the case of a quant fund would be all of the data that it's taking in order to make the decisions downstream from that. So that would be asset prices, geospatial data, capacity utilization for a factory, anything that you can think of that might be useful for predicting or for optimizing that shareholder value. That's what the corporation's going to use for sensors. The actuator side of the equation would be like in a humanoid robot. That's the actual interface with the world. With a corporation, that might be your employees, or it would be your API calls to a brokerage, or whatever it is. And so those as well, those would be which brokerage accounts do you have? In the case of a modern quant fund, that would be like how much AUM do you have? What kind of margin contracts do you have? What kind of broker dealer relationships do you have? Do you have friends in the SEC, whatever things it might be? And then there's the map sort of between the two, which broadly speaking we kind of consider as this parameters thing. So this would be if you have a model that's taking in that data and then mapping that data to predictions of what it thinks that data is going to look like in the future. You probably have a neural network doing that these days. That's your parameters, right? That would be like your API compute. That's your literal neural network architecture, the trained weights of it. And then in the case of quant fund, you have this vector of deployed assets that are already on the market. So this would be like your current portfolio holdings, which we'll term I here. So this is like this would be like, I have this much Apple, I have this much Google, I have this much commodity, I have this much gold, I have this much oil. You have an outstanding portfolio of assets that are sitting there. And the reason we specify this variable separately from the rest of your data is that it turns out to just be nicer for equation's sake. These variables here are not like mutually exclusive. It's just a nice way to kind of slice things. And then the last thing is this R&D symbol here. And this one is going to be very important. R&D is essentially how the firm processes information about itself. So this would be all of its previous trades, all of the previous model parameters, all of the experiments that it's run, all of its previous data that it's received, essentially a history of all of that information. And it uses that information. That would be any of the expenditures or any of the operational capabilities to improve the other things here. So this would be like your sensors. If you want to get better sensors, you want to acquire more data. Roughly speaking, we'll just call that R&D. Or if you want to get a bigger neural network or buy a bigger supercomputer, that would be R&D, right? And so with these 5 things here, what we do is we say, okay, cool. This is a state vector. So there's a stock of these variables at any given time that you could measure in dollars. And then there's an action vector. So an investment action would be rebalancing your portfolio. Your sensor action would be acquiring new data. Your actuator action would be spending cash to acquire a new brokerage contract. R&D would be hiring researchers or running an auto research experiment or whatever it is. And then your parameters would be running a training run to make the model bigger or something like that. Now the world in which this corporation is living is broadly speaking, they'll call it the environment in a lot of the literature. The corporation is not separate from it, right? This is kind of like the Markov blanket. They call that in the sort of active inference community, I believe. This is basically like where are the boundaries of the corporation, the Coesian boundaries, so to speak. And if the firm is small, if you're very tiny and you manage like 100K or something, you're not going to affect the market in which you're trading. You're not going to affect the GPU market when you're trying to buy GPUs. So for the sake of this paper, we assume that that is true, but it actually doesn't change the underlying equations. You just need to account for it with some cool math from markup blanket adjacent stuff. But for the sake of this, we're going to say essentially that the state of the corporation and the state of the exogenous things that are outside of it, so that would be like government things, wars, whatever, we're going to assume that those are separate just because it makes the equations look nice. So we'll call that the small firm approximation. But basically, we're actually going to go back to the self-forecasting loop. What the central object that resides inside the neural network is this economic world model. And what this is it's a joint transition function approximation of, in this state, given a certain action, what is the next state? What is the next state? What is the next state? So it's this ability for you to predict as a function of you doing a trade or you doing a R&D investment. What is the state of the corporation going to look like next? And what is the state of the environment outside of the corporation going to look like next? So in practice, this could be two separate neural networks. This could be, it could not even be neural networks. You could have a variety of different ways to model it. But this joint economic world model is sort of what I think the central object that a recursively self-improving quant fund will have. It's an object that allows you to run literally Monte Carlo rollouts eventually, but make predictions about what the future state of the corporation and the environment is going to look like. And as the firm makes these decisions, as it operates in the world, it's going to start to collect histories, channel-specific histories. We had the sensors, actuators, parameters and things like that, going to start to collect histories of the decisions that it made in the past and what was the result of that. And it's going to collect rollouts, right, in a sort of reinforcement learning term. As you go through this process, this history gets bigger and bigger and bigger. You can learn more and more from it. You can acquire data about the environment. Usually you can just buy, data from an API or something. But over time, the firm is going to collect more and more history. And what that eventually will allow you to do is to start to forecast the effects that your decisions will have on the corporation. It'll start to allow you to do this sort of self-forecasting loop where you can predict what the marginal experiment or the marginal improvement in data will do to your reward. What will the marginal return for the most people think like, oh, just the trading stuff. Obviously, if I rebalance my portfolio, I'll be able to, predict what the returns on that rebalance are going to be. But if you run enough experiments, you'll start to be able to predict, well, as I add data, if I go and acquire more data, what is the marginal return on equity that I get from that? What is the marginal return on equity for adding a new brokerage? Or even, potentially, what is the marginal return on equity for some sort of research experiment? And so that's what the rest of the paper is about: is how do we construct this self-forecasting loop? How do you construct something that can predict itself? We'll kind of skip down here a little bit. Yeah, this channel-specific world model thing. We'll also skip past this for now. So let's go to here. Yeah. So if we treat this sensors as an asset, what we found is that there are very predictable scaling laws for data. So as we add more data to the model, there are very predictable scaling laws. In other words, the channel-specific history of data. As we've collected more and more data, as we've run more experiments, we've found that there are very predictable scaling laws for data. In other words, if we add more data, we can tell you how much better the model's loss will get. And from that, we can tell you how much better the returns of the algorithm that is trading will be, which tells us the marginal return on equity. So we have a direct line that we can use, we can calculate derivatives on from the equity of the corporation all the way back to a marginal change in data. So this here, we already are starting to see like, cool, for each gigabyte of data, how much is that worth to the company? And we have the equations for it. And so, if we can see here, we have a few more orders of magnitude worth of data that we could scale. And so we have the parameters fit to this. Similar thing on this actuator side, we can start to see as we add the ability to trade more assets, what does the marginal return, and for some reason the y-axes aren't rendering here, but it's the annualized return in this case, as we add the ability to trade more assets, holding the number of assets it's trained on fixed. And you see that there's also predictable scaling laws on the model's ability to make money as you give it more assets to trade on. And so that's another thing where if you can establish these scaling laws, they're the most straightforward way to be able to predict very easily with very simple equations what is the sort of return on an investment in adding more assets. You can go figure out how much it costs, and then once again you can do the chain rule and get all the way back to the change in equity of the corporation as a function of changes in actuators. And this one's for Sharp because a lot of finance people like it, but we have the numbers we fit here. Now the R&D one is the most interesting one because this is the one that a lot of people are kind of like, this is where the uh-oh or the fooms or this kind of stuff comes from. It's all about if you're trying to measure the marginal, because what we're trying to do here is measure the marginal return per research and development experiment. And so there's this recent trend of auto research stuff where you can start to say, if I have Claude, what is the new one, Fable 5, run an experiment, and then I collect a bunch of data sets of that, how much better does the prediction get as a function of those auto research experiments? And you can start to collect data sets on that. And so we've started doing that as well, where we can see, we can start to measure or understand the process, this stochastic process, which this follows the same type of the math you use to model this, it turns out, is similar to like world record modeling. We're trying to predict like how much is the 100-meter dash going to get better over time. You kind of want to do the same thing here. And like how much is my best model? So you start to model this as well, and then you can come up with once you do this and your standard error gets small enough, you can start to say things like, if I run an auto research experiment right now, how much return on equity do I get? And so now we have not only the sensors modeled, so we can tell how much money we get or how much better the company is from data. We can also do it from actuators. We can also do it from research and development. Doing it from investments is rather trivial. We kind of skipped over it, but that's kind of the whole bulk of all of quantitative finance is if I rebalance my portfolio, what's my return on equity? And so the last one is sort of the parameters, and that's the one that we don't have any information on this paper yet because the experiments are currently being run as we speak. But that essentially is if we scale up the size of a model, for example, you can get there's these Kaplan chinchilla scaling laws that will tell you the optimal ratio of data to parameters. If we can start to get an idea of how much bigger does the model get, we can figure out how much that costs based on AWS compute prices. We can say, all right, cool, if we make the model this much bigger, or if we change the architecture to this type of architecture, how much better does the model get? How much does the loss go down? And if we can get a scaling law on that, which evidence suggests that we can, then we'll have be able to say what is the marginal return on making the model have more parameters. And then we can go from loss to trading to change in corporate equity. And then we'll have essentially a rudimentary solution to the problem of turning the entire self-improvement process into a self-improvement or into a reinforcement learning or portfolio optimization problem where we can look at the marginal return on research and the marginal return on all these things and say, what is our best decision right now that we could make to increase equity next period or over a discounted sum of the next periods? And so that's really what the parameters as an asset one here, where we say we have some model sweep is forthcoming, right? There is some interesting stuff about continual learning we could talk about as well, but that's kind of the idea is that in quantitative finance, because everything is so complete with language models and with a good team, I think that these are the first companies that are going to be able to recursively self-improve. And there's a bunch of other things in the paper and some other appendices, but that's kind of the general thesis of what our paper is about. And we kind of show the first preliminary evidence of what this would look like in practice.
Thank you.
Excellent.
Great.
Super interesting. And
Tucker?
I'll open it
Yeah.
up with a few of my thoughts and maybe a question. I just want to say to start off, the fact that you drew the initial parallel from Brownian motion of particles and the Brownian motion as volatility and the drift as the return curve texture just goes to illustrate how, as above, so below, alpha to omega, these natural and man-made systems always go back to the same deep patterns that are found at every scale. And that just, for me, speaks to, truth's not the right word, it speaks to the reality of them and that these patterns actually are emergent and can be seen and witnessed. And your work here is helping to elucidate that in economics, which I think is super cool and just when you see it in nature, when you see it in an economy, when you see it in the Bitcoin price, when you see it in the behavior of ant colonies or in the movement of particles, it just reminds us how beautiful and interconnected the world is. So super pleasant to hear that. And then one of my questions was going to be maybe speaking about the nuts and bolts of actual like the trading architecture that an agent like this would have. Are the
Mhm.
tools that are afforded to an agent, I'm using the term agent to speak to this recursive self-improving
Yeah.
model or corporation. Is that also a parameter? Because you can imagine you can give it different derivatives capabilities. Can it buy insurance? Can it participate in all kinds of markets, whether that's prediction markets, traditional stock exchanges, buying commodities, taking equity in private corporations? So how does that come into the equation?
Yeah. So there's sort of two. I'd say they're different. They're sort of like like they're differences in degree and differences in kind. There's sort of two separate types of changes, I would say. So one of them is like, let's say that you're already trying to approximate like equities, and let's say they're only looking. There's approximately 30,000 equities and ETFs that have traded on the U.S. stock market since 2004. So let's say that you're only looking at 100 of them, and then you say, well, I've looked at this scaling law. I can see it. It's working. So this one here, the one we were looking at earlier, um, this one. So this here is exactly this kind of thing, right? So this one goes from one asset, so you can pick a set of one asset, so you get some confidence interval on there, and then you continue to increase the number of assets. That's one way to kind of look at it. You'll notice though here that the x-axis is dollar weighted tokens. So this is actually not a concept that we kind of came up with, although we kind of came up with it independently. There's this a paper called from 2025 from Muninghoff, I believe is the author, but it's a scaling law paper. And so the question is, what is the right x-axis that you want to include whenever you're trying to come up with these scaling laws? And so we did a bunch of research into like what is a scaling law? Like how do you measure it? And you want to do these, they call them quality adjusted tokens. So the idea would be, um, in any kind of system, they're sort of conserved quantities, right? So like in the case of energy is conserved in physical systems. So you kind of think like, what is the sort of conserved quantity of finance? And excluding inflation, which is also to some degree conserved because it's printing money usually, although there is other things. Um, there's sort of conserved dollars is what we found. And so we
Yeah.
found that if we take the information, if we take number of assets traded, the R squared on this line is nowhere near as strong. In other words, it's not as good if you don't normalize by whatever the conserved quantity is, you tend to get these much thicker confidence intervals. The trends are not as clear. But if instead you say, well, what we really care about is what is the flow of capital moving from one place to another. We're trying to model the flow of capital across the entire economy. Like we have these lines here. You'll see around 10 to the 16, 10 to the 17. Um, this first line represents all asset prices that you could have access to. So this would be, I guess I can't zoom in very well, but change it. But this line here corresponds to if we had all bonds, all stocks, all commodities, all real estate, all interest rate swaps, private equity, like all of the derivatives. And to the best of our ability, we try to come up with these like understanding of approximately how many dollars are in tradable markets that we could realistically get access to in dollar terms. And so as you increase the amount of dollars under observation, in that sense, you get increasingly better predictions. Is sort of the first thing. This second line here is not it's non-market. It's not markets in the sense that I'm buying a security or something or a commodity. This would include like credit card transactions and like gas being pumped at your gas station and input output tables from all of the different industries to each other of buying and selling products. And um, basically that's what these two lines are here. So I think that the dollar weighting of one thing is one thing that is very important in understanding how these scaling laws work. When it comes to like the first kind of part of your question, which was how does the actual trading infrastructure itself work for an agent and like what are the affordances given? The right way to think about it is sort of if I give an additional affordance to, we'll say the agent, it is giving it exposure to a much larger set of dollar weighted tokens that it can act upon, right? So you could theoretically imagine at first it's just going to be these highly API complete, I can just send an order to the New York Stock Exchange super easily. But as these humanoid robots come online and as, container ships and we add more automation and more, control systems into the real world that are API complete, you can imagine that an entity like this could also start to command, factories. And there's those whole like lights out factories in China. So you can imagine systems like this also controlling factories or also controlling individual humanoid robots or drones or any some more interesting things like rockets or whatever else. And so that's kind of the way I think is that the that would be more like the change of kind inside of a given domain where you're saying I'm just increasing the number of assets that I'm able to trade within a given domain. So just increasing from 100 equities to 1,000. That's very predictable. There's these disjoint breaks to some degree, and that's one of the things we're going to prove out here is does this scaling law continue purely as a function of dollars? Is this truly a conserved quantity, or is this just an equity-centric, market-centric scaling law? Does this also continue if you add credit card data or geospatial or whatever else? But yeah, I would say that that's kind of my thoughts on it, probably.
Yeah. Also
Okay, great. Can I
these,
have follow-up questions, Dan, please?
yeah, just on these scaling laws, really interesting how the log axes and how that connects to scaling laws. Like, what is the natural size limits or Pareto optimal morphologies for different firms? Like, for example, trading only one asset, you stand to gain by adding a second asset, but the marginal on the next asset starts to decrease. So then there
Yeah, like
becomes
there's
some sort of,
here.
yeah. So and analogously for sensor channels and for actuators, they all have this logarithmic
This kind of power law decay,
relationship.
yeah.
Yeah, so it's like that's like the diffusion level of oxygen. And then that relates to what kinds of morphologies within a given circulatory system can exist and how their metabolic rates relate. So just like we wouldn't expect to see all of the assets necessarily traded by one entity because it might get outmaneuvered by several smaller medium scale. And so like just the ways that and how that triple intersection, which is where it's all driving towards with the financial, the epistemic value of the value of information, reduction of uncertainty about something informational, and then grounding it into the joule and the electricity. And however that loop gets closed by Bitcoin miners or by data center and that kind of triad, understanding it is the total operating environment of any cyber-physical system nowadays. So having these strong analytical and empirical relationships that help you convert amongst them, you're never going to do worse actually by knowing better about that triad. And worst case scenario, you're going to be throwing out too many or too few auto research dispatches and just vibing whether you rent one GPU or 5,000 and not knowing how that connects to the marginal relevance for the actual group.
Yeah, like there's a few things that are kind of interesting here. So the one of the things that's interesting, so the y-axis here, for some reason, it's the median absolute deviation. So median absolute error on a um, per asset basis. So this is like per data stream, so to speak. What this is really to do is that the predictions per asset go down as you add other assets. So that's kind of that's one thing that's kind of interesting. It well characterizes the fact that the economy is a graph, right? There is a bunch of relationships between different entities, and as I give you marginal, as you cover sort of larger and larger, subset of that underlying graph, you get simultaneously better at predicting everything on it, which is one of the things that's kind of interesting. There is this sort of intrinsic noise floor, though. Now, one of the things that's interesting is you'll notice these numbers range from 0.18 down to 0.05 or whatever. If you look at language model scaling laws, and you say, okay, well, what do those look like? The loss function that they're measuring is usually binary cross entropy, which means that they're saying, what is the sort of KL divergence, or what is the difference between this vector and this vector? And so those numbers tend to be much larger. Just numerically, that's just what you end up seeing. Whereas this is a regression loss. They're doing a classification loss. So the classification losses actually look different. One thing that we found that's kind of interesting is if instead if you turn this problem of trying to regress, you're trying to predict, this is what I think the price should be, here's what it actually was, I'm going to take the difference between them and square it, and that's my loss. If instead you turn it into what they call a pinball loss, which is you're trying to classify what the next return is going to be into a bin along the distribution of possible futures. So you have sort of a bell curve there, and you're saying which part of the bell curve is going to be located on. The loss, it turns out that's actually a better way to do this. Another term for this is distributional reinforcement learning. And so a lot of the field is moving that direction just because it turns out, one, it has some nice properties, and there's some like information geometry ways of reasons why it's better for training these models. But it also changes the way that these scaling laws look. Because this one here, this is a remarkably like accurate scaling law. So we have a noise floor that we've actually estimated here in terms of like what is the minimum possible amount of information that we could possibly get asymptotically. And we have like an estimate here. I believe it's about 0.3. Yeah, the noise floor. So it's about 0.42. And this is estimated using hierarchical Bayesian posterior estimation thing using NumPyro. But the truth is that this noise floor is a function of the architecture itself in practice, and it also is a function of the loss function. So I think that the particular curvature of this chart, if you look at language models, they don't even do this. They don't model a noise floor because the numbers tend to be so much larger that you can continue to go. You can make projections out several orders of magnitude, and you won't have predictions that are better than, or that are like lower than zero, essentially. In this case, because of the type of loss function we're using, we're seeing curvature here that with slight changes in the loss function, it'll actually, this equation would, or this line would look a little bit different, and you wouldn't need to put that noise floor on it. So there are some like, pretty subtle things you can do to kind of affect this. It is true though that when you kind of zoom out and you look at like what it is that we're doing here, there is a lot of similarities between this and like everything else. Like all of these, like these scaling laws, the fact that like a circulatory system is fractal in nature. The same thing is true of the economy. There is highly fractal. You can observe trends at a variety of different scales. And so that's one of there's just, you tend to observe these power law type loss curves anytime you're trying to learn something on a fractal geometry. You see this power law fractal stuff is all over the place. So anytime you're trying to learn a fractal system, which the economy is, you do get these kind of like, power law decay and loss. It's very interesting. These ones, however, don't appear to have that, although this is, these tend to go up more linearly, which is kind of interesting. I'm not exactly sure why that is, but it is kind of interesting. We fit a bunch of curves to it, and there's no difference between linear and just having it be a polynomial or whatever. It's just a straight line, it seems, in terms of the annualized returns.
That would suggest if we simply make more assets, we can simply increase the returns.
It would seem so, yes. It seems that as long as we don't run out of ideas, there is more money to be made. There is one thing that's pretty cool here, continual learning regime. So this is the line we were just looking at, is this blue one here. Although this is taking the loss summed across all of the predictions, right? And this orange line here is the amount of loss that we see. Because this blue one is we train till convergence. So whenever the model is done training and we're like, cool, this is as good as it's going to get. And so that's kind of interesting. This orange one is the amount of loss after one epoch of training. So it's seen the data once. What does it learn, right? What we see is that these lines get closer and closer together as we increase size. And so we can project forward and say, when do we expect that in looking at the data once, we will already achieve a loss that is optimal? Basically, we will only need to do one epoch. And then what happens when we need less than that? Like what happens when we need half of the entire data set to perfectly learn it? What if we had what's way out here on the 1E17 territory when we get up to that data? Our expectation is that we could train a model, and with very, very few samples, it can completely understand the dynamics of the economy, which means that we can just update it relatively infrequently in practice, and it will be highly resistant to like regime change because it can just learn the new regime immediately as it goes on. But I think that this is kind of what continual learning shows, is that as you increase model size and model weights, and I don't know how much, this is kind of a novel-ish research. There's not as much going into this, showing that as you increase the data size, basically you need less and less epochs until eventually you converge and you only need one epoch, and then you need sub. You only need a small portion of your data. So this is one of our objectives as well, is to get to the domain where we don't need to update the model, or we can update the model every day, and it'll always be, that's all that it needs in order to perfectly learn the new dynamics.
Yeah, that was actually going to be my next question is how do you think about the time scaling, or to put it in a Bayesian sense, how often is the agent sampling its environment? Because combinatorially, it could be infinite if it has to survey every bit of data at different amounts of time, and sub-millisecond sampling, millisecond sampling, day by sampling, quarterly sampling. So how does the agent go about solving that problem? And to your point you just made, like the optimal is that you do it as infrequently as possible and you're able to interpolate a really accurate picture, but how will that be resolved?
Yeah, so I think there are actually two. So in practice, the kind of goal of the company is, we kind of talk about it, is like towards, we said towards a differentiable corporation is kind of the objective, right? And so part of this is how, what kinds of decisions do you make? Part of the decision you want to make is, I want to have a good posterior over all of the parameters of my scaling laws, let's say. So I have, I could run a new experiment that will tighten my confidence interval on one of the parameters that I'm using to optimize my company. And at the same time, it's basically the difference between explore and exploit. And I think that the explore side of things will have a different frequency of experiment, a different frequency of decision making, of updating those posteriors. You'll have a different frequency than the exploit side of things, which is just like, I'm going to trade, I'm going to run a bigger scaling law, I'm going to do the sort of adjacent thing that I know will work very well with high confidence. That kind of stuff that stuff is relatively easy to exploit. It's on the Explorer side of things where you're like, my standard error on this parameter is relatively large. In other words, I don't have that would roughly correspond to a large, confidence interval on a given parameter. I could run more experiments to tighten that confidence interval, but those cost money. And so there is actually a relative value for tightening that confidence interval, for getting a better understanding of what a given parameter is. And that might, in fact, that reduction in uncertainty itself might be more valuable occasionally than it is to exploit the things you've already done. And so I think that probably what it'll look like is, on a day-to-day basis, we'll be updating the neural networks, consistently in order to do exploitation stuff. But occasionally we'll reach a point where, especially if a lot of uncertainty happens, where we'll say, we're not really sure if this scaling law, or this specific parameter, like if our scaling law parameter, we're starting to get a wide confidence interval here. It's not entirely clear that making it bigger is better anymore. Cool. We might start running more experiments in order to narrow that confidence interval, in order to say, all right, well, what is there? Or we might run more experiments on the research side. So I think that it's going to be very much like a low level, optimization and updates of those, getting a better posterior pretty consistently at the exploit layer. And on the explore layer, we're going to be, doing that less frequently as a function of the uncertainty. We kind of talk about that in the t-RSI thing here, where this is over a 90-day horizon. What is the improvement that we get in the algorithm as a function of research and development and improving the algorithm? And then we have this decay, which is how much worse does the algorithm get as a function of the market learning our strategy or whatever else. And as long as there's a distance between these, then you see you're going to get your derivative essentially is getting steeper. And then once these two are equal, that means that the derivative of your self-improvement is static. You're no longer able to improve faster than you're decaying. And then so this is essentially an analog, or it could be understood as the S curve of any corporation, or the S curve of any system. As long as this blue one is bigger than this red one, we're in the getting faster exponential phase. If it ever gets, so like as the fund gets bigger, it's going to get harder and harder to make more money, right? So that would be this red thing getting closer. If our technology gets much better and it turns out that, Mythos 6 or Mythos 7, or if we make our own language model, maybe this will get a little bit farther away. Or maybe we'll find a new algorithm that is like significantly better at scaling. So that's kind of there's a balance between these two things here. And you can also, exploiting it is basically keeps this distribution the same. But the decay is going to start creeping up on us, and the exploration is going to move this out again. So it's like there's going to be a competition between, well, if we have a huge distance here, we should just exploit right now. If they start to get up on each other, we want to move that distribution ahead. And so it's going to be a process of that.
Well, as we head into this last little bit, York, what are your group's next moves? How can our extremely small, so extremely high quality Talktopteran audience learn or do more?
Yeah, so I think and to talk about what we're doing next, the corporation at this point, as we can see here in this chart, we have a large distance between the amount of capital, or basically the amount of improvement we can get, versus the decay. What we call this is like the t-RSI, so to speak. This is like the distance between decay and alpha. Right now, because it's large, we're in the exploit stage. And what that means is that for each marginal unit of capital that we get, we can deploy it and get an enormous amount of return far and above what it actually costs us to get that return. And so for now, what we're doing is we're raising significant amounts of capital from probably venture and all, if we have to, but more interested in individuals who are actually interested in funding work like this, not because they want to dump a product on retail at an IPO at some point, but because we need to make sure that there are reasonable heads that are actually considering, if we're going to be building AI, we need to actually care about how much it costs, right? Like we need to we need to actually pay attention to these things. Like, what are the economic impacts? There's some really cool work that we're about to release, actually, that's on that is an economic graph. It's our current best graph of the economy. So it's like $50 trillion worth of dollars moving around at a quarterly frequency, all of the inputs and outputs from every industry. And then on top of that, for each industry, what are the different jobs that are employed in this industry? And then for each one of those jobs, what are the tasks that each person at that job does? And then what is the automatability from language models of each one of those tasks? So you can kind of go back up the daisy chain and you can actually come up with numbers like, what is the dollar value of the automatable tasks in this industry? So it can tell you what the AI, basically language models impact is going to be on glass blowing industry and whatever else. And it's this kind of like, I think it's incredibly important going forward that we move from this era of only focusing on language, which language is really cool, but there's also protein folding and therapeutics and a bunch of things there. There's a bunch of things in, Fei-Fei Li and Jan LeCun's companies. There's a bunch of things in humanoid robots. There's a bunch of economic things like what we're doing. And our kind of objective really is to start the move away from just language and starting to focus more where people can start to, focus on things that are directly economic in nature. There are no companies really that are trying to understand GDP better than we currently understand it. And our real objective here is, and what we're doing right now is we're just raising the capital we need to do a little bit more exploitation to get this a little bit bigger, to make our models better, so that we can follow these scaling laws, so we can get the auto research running, and then to use that to improve capital allocation at scale in the United States. So our eventual first big product, and when most people will actually hear about our company, is we're going to launch an ETF that's managed by our AI. And people can put money into that. And instead of having your capital allocation algorithm be one that's driven entirely by size, which is the way that the world works today with the index funds, I believe that in the future, AI is going to manage the capital. Like just like how AI could be your doctor, AI could be these things. AI is going to be the retirement account manager. You're, instead of it being the world's simplest algorithm, if size is big, buy, it's going to be looking at every single thing in the entire economy, all of the graphs, and saying, what is the best possible risk-adjusted return that I can make with this person's capital? And if we can get that to happen at scale, our entire economy is going to grow so much faster. And we're not going to I think we can potentially eliminate recessions if humanity decides to do this. We live in a world where our capital allocation doesn't make dumb decisions in the short term, where we actually account for the fact that there's a right price for things. And if we can do that at scale, that would be a much better vision, and we can actually fund space exploration to the tune of trillions of dollars because we'll be able to properly value it. So that's kind of our long-term goal. Is we want to be the kind of like Elon did, where he forced other car manufacturers to care about electric cars. We want to force asset managers to use AI by showing that it can be done. And if we can do that, then I think we'll have succeeded.
Tucker, do you have a poetic closing note?
Well, to reiterate one of the points that you made, York, in the middle of the conversation about how the economy is like a natural system and economics is an energy exchange, ultimately, abstractly, it seems inevitable that intelligent, cybernetic, digitally based agents and intelligences are going to be the dominant actors in that space. Just like in the jungle, it's the apex predators. Um, and so we're just at the dawn of that, and of all the work that I've seen so far, your guys' take on the economic agent seems to be the furthest along and the most holistic view of how to build that. So it's very exciting, and you can see how it's going to touch everything from a simple ETF trading agent in the beginning to something that eventually is pulling levers in the real world across factories, space, the entire economy. It's really exciting. Just one niche question, or not niche question, but
Mhm.
a specific question for your guys' capital raise. Do you guys have a lower capital limit for individuals to invest? Just so if anyone out there wants to reach out to you guys.
I mean, we're doing like for people we like, not really. I mean, I think we're very much on the uh, I would say I'm kind of a populist, to be honest, and I think that's kind of the point. Is like, if you're OpenAI, if you wanted to be invested in them, that you couldn't, right? And they kind of the retail now they can when it's already worth $1 trillion. And our kind of a thesis has always been, I want the people who can invest in my company, I want them to be able to invest 1 cent. Um, and that's really the cool thing about ETFs is we can do that. And so, like, I would say very much so, we're on the side of, yeah, probably not 1 cent, but like, if we've had some of our like friends and some of the people where they were like, I only have, they can't write 100K, and of course there are like regulatory constraints on that kind of thing. But insofar as that is, attested to, like, yeah, we'll take money from people we think kind of understand where we're at and where these things are going. And one thing that you mentioned actually that is kind of interesting is the cybernetics side of things, and a lot of the almost kind of some of the Nick Land style stuff, I think, actually, where cybernetics, interestingly enough, Norbert Wiener and a lot of that stuff there, the stochastic process stuff is a direct predecessor to reinforcement learning, direct predecessor to model predictive control, direct predecessor to the stuff that all of AI is doing today. It was at one point, back in the 30s and 40s, that's what it was. Like, that was the state of the art. And it's very cool because there's this route that we've taken through history, and it really is, it kind of looks like an inverse tree where it's like there's all these different fields of science, probability theory and measure theory and set theory and calculus and all these things, and they kind of, you know, trickle together until they combine into this stochastic optimal control, sequential decision making under uncertainty thing. And it's really cool to see, like, I can look at a quantum computing paper and very quickly realize, oh yeah, here's exactly, like, you can literally take quantum computing, quantum optimization algorithms, and just there's equations that allow you to turn a wave function into a Hamilton-Jacobi-Bellman equation, which is in reinforcement learning. So all this stuff is connected. It really is. It's kind of crazy when you see it, but it's very cool as well.
York, thank you for the openness and willingness. And I will just
Thanks for
close
having
with
me.
a short William Blake line. He wrote, "Reason, or the ratio of all we have already known, is not the same that it shall be when we know more."
Good quote.
Thank
Asian.
you. Farewell.
Godspeed.
You too, York. Looking forward to hearing more, man. Good luck.
Thanks.